Welcome back, everyone, to my stock market weekly update series, which I post every Saturday. And this week we've got some crazy stuff to cover. Of course, we had a huge week for the markets. They really shot up by quite a lot because of that inflation report that I told you guys to keep an eye on. By the way, I mentioned in last week's video, keep an eye on that inflation report. It's going to really drive the market either up or down. And that's exactly what happens. So we'll cover that in today's video. We'll also talk about some earnings that came out for some very popular stocks, including Disney and Palantir. And we'll also just quickly touch on the midterm elections. I'll give my quick little opinion on it. And then we'll finish up the video with the biggest gainers and losers for the week. And I'll just quickly let you know if anything catches my eye there for possible investment. But it's going to be a fun one. Hope you guys enjoy it. Let's go ahead and just jump straight into this. All right, and starting first here with the markets, the Dow Jones rose over 4% this week, while the S&P 500 performed even better, climbing by over 6%, and then the tech-heavy Nasdaq saw the biggest gains of all with over an 8% climb. It was really a strong week for the markets, and of course the Nasdaq has been beaten down the worst than these other two this past year, and that's why it had a bigger pop on the good news. From their highs though, the S&P 500 has now managed to squeeze out of bear market territory, but it is still down a significant 17% from the top, while the Nasdaq is still suffering a very strong crash of over 30%. Turning to the news though, of course, all eyes were on the October CPI report, the Consumer Price Index, that was released on Thursday morning by the Bureau of Labor Statistics, who reported lower inflation than what analysts and economists were projecting at a month-over-month increase of 0.4% versus 0.6% expected, and a year-over-year increase of 7.7% versus 7.9% expected. And this was to the joy of Wall Street, who seems to be pricing in the possibility that inflation may have peaked and thus the Fed can finally start to slow down their interest rate hikes. For some context, the Fed has already raised rates a whopping 6 times this year in what has been the sharpest increase in rates since the 1980s. On the left, there is the yellow arrow showing our sharp increases on this chart here for this year. And just last week, the Fed had elected to raise rates, but they also noted that they may slow down their rate hikes if inflation starts to get under control. Well, it's looking like that may at least be starting, as year-over-year inflation seems to have peaked back in June, where it rose by over 9% and proceeded to decline every single month since then for the past 4 months in a row. In reaction to it, Moody's Analytics released a statement saying that it's pretty clear that inflation has definitely peaked and is now rolling over. All the trend lines suggest that it will continue to moderate going forward, assuming that nothing goes off the rails. As good as all of that may seem though, I'm a little more pessimistic here in the short term, because even after the decline, we are still at the highest inflation levels in over 4 decades, and I just personally feel that the market rally was so large this week that it almost feels like the market is expecting the Fed to start slowing down their rate hikes immediately by the next meeting, which I think is still just a little too soon to assume that. Now, long term, I'm the biggest optimist out there because I've been telling you guys from the beginning that I still think supply chains are going to be restored soon, and we've been raising rates by such an incredibly sharp rate that I think inflation will start to tumble down very dramatically. And when that happens, I think the Fed will pause or even lower rates, which I think will send the stock market soaring. So long term, I'm still very optimistic. And like you've seen in videos, I've been buying tons of stocks. I think there's a lot of value out there in the market. But in the short term, I still think there's going to be a lot of volatility. And I don't think the Fed is going to be stopping yet. I think there's still some more rate hikes coming. And that's just personally how I feel, but long term, I'm still pretty optimistic. Anyway, talking about the market, let's turn over now to earnings, because a couple very popular stocks reported this week, including Disney and Palantir, which, by the way, are both stocks that I actually own myself. Unfortunately, though, both stocks had a very bad week. In fact, Disney stock actually crashed by over 13% just on Wednesday alone after reporting, but only fell by 5% for the week thanks to the market lifting them back up at the end of it. But from their highs, Disney has already lost more than half of their entire value in what has been one of the biggest crashes that I've ever seen in the stock. Very similar to the 2020 crash, by the way. Now, as far as those earnings go, the reason for the fall this week was mostly because they missed on both the top and bottom line while also lowering future guidance. Now, there were actually some bright spots in the report, like, for example, Disney Plus subscribers reaching over 164 million subs versus 160 expected, leaving their total sub count when you combine Hulu and ESPN Plus with Disney Plus at a whopping over 235 million, which, by the way, is significantly higher than the 223 million that Netflix currently has. They just reported that in their earnings report a little while back. However, the segment is still far from profitable, losing them another $1.5 billion in the quarter, while Disney Plus itself is not expected to reach profitability until 2024. To remedy that, though, Disney is planning to raise prices next month while also adding an ad-supported version to boost revenue as much as possible. Personally, as a subscriber, I hate that move myself. I don't want to pay higher prices, and I certainly don't want an ad-supported version. I'm sick of commercials. I always just elect to pay to not have commercials. But in this particular case, I do understand that they need to do whatever they can to reach profitability as soon as possible because it continues to bleed money for them at this time. So as an investor, I can understand it, but as a consumer, I obviously hate it. Anyway, turning to other parts of the business, their in-person businesses that includes, things like theme parks and resorts and cruises and more. Well, that segment actually soared by more than 34% this quarter thanks to businesses, really opening back up, people being less afraid of the pandemic, going outside and enjoying those things. However, even that still missed analyst estimates, while media and entertainment saw revenue actually decline by 3% because of the lack of any big blockbuster movie releases, which also miss expectations. I don't know about you guys, but I'm sick of there not being any big movies out. Like it really feels like Hollywood is just not trying anymore to put out any big movies out in the theaters. Seems like everything is just heading to streaming. I'm not a big fan of that, but it is what it is. Anyway, probably the biggest issue of all that really scared investors is that going forward, Disney is now guiding for next quarter's revenue to only grow by 10% versus the more than double growth rate that they saw this quarter of 22%. Personally, I still like Disney stock long term, and I think their growth will still be pretty good, even if it's not enough to please investors at this time. But for the foreseeable future, just know that Disney stock will likely continue to be extremely volatile. Turning over to Palantir, though, this is a speculative stock that I also own myself, and unfortunately, they too reported a miss on the bottom line. However, I actually liked a lot of the stuff that I saw in the report, because not only did they beat on revenue, but it soared by over 22% for the quarter, with commercial revenue in specific skyrocketing by well over 50%. And that's probably the most important segment for them because it really helps them diversify away from just government contracts, which can really be up and down sometimes. And it opens up a giant commercial market where they can sell their data analytics and data management software and services to help businesses run more efficiently, which I think will be in huge demand over the long term. That's where I see them really making their biggest, sales and profits. And while Palantir has been losing millions of dollars per year, this latest quarter actually saw them post positive EPS thanks to that commercial segment growing its customer count by a massive 124%. From 59 businesses last year to 132 today. In a letter to shareholders, the CEO stated that Palantir is in the early stages of significant transformation. And look, I completely agree with him. He did note that Europe has been a more difficult market to break into because of stubbornness from those foreign companies that are not, as willing to change the way that they run their businesses, especially from, a foreign company helping them. But here in the States, the CEO mentioned that several different regional markets could develop into billion-dollar businesses over time for them. And despite the stock sinking by over 11% just on Monday alone, The end of the week market rally actually resulted in Palantir climbing by over 6% for the week, so it's kind of surprising. That's because the stock has been one of the worst, really beaten down spec stocks in the market, and it's still down by over half their value just this year alone. But long term, I do have very high hopes for this one, so I remain invested. And just to finish up here with the market news, there was, of course, the midterm elections this week. The most notable results of which were that Republicans are likely to take back control of the House, while another runoff election will take place in Georgia that will likely determine if Republicans are able to gain majority of the Senate as well. But overall, I don't like to go too heavy into politics because of obvious reasons. It's a very polarizing subject. People get very angry, offended very easily when it comes to politics. So I try not to talk about it too much on my channel and just stick more so to stock market investing. But in terms of these midterms, I will just say it's looking like we're going to end up with a little more of a divided government. I would assume that things are not going to change very much from these midterms, and the stock market usually likes that. I mean, the stock market likes certainty, it doesn't like big changes, so a divided government means that nothing usually gets done and things just kind of stay the same. So that's personally how I feel about these midterms. I think the bigger influence on the stock market will be the Fed and their decisions with interest rates and what they'll be doing and inflation. And those are the things that I would pay more attention to, at least just in the very short term. I'm not saying don't get political, do whatever you want, but I'm just saying what's going to influence the market. I think right now the Fed and inflation and interest rates, I think that's what's driving the market as of right now specifically. Anyway, with that said, did I do a good job of navigating my way through that political minefield, by the way? I don't know. Hopefully I did. Anyway, let's transition now to the biggest gainers and losers. I'll just quickly list off for you guys what those were, and I'll let you know if anything caught my eye this past week. Okay, and starting here with the gainers first, Fair Isaac and Company saw the biggest climb at almost a 40% pop for the week, which is the financial data analytics company that is famous for the FICO credit rating. And this week they beat on earnings, which sent the stock skyrocketing on Thursday by over 30%, which was probably boosted by the market rally even further. But this now leaves them at an all-time high with a valuation that is extremely more expensive than the rest of the sector. So considering that they don't even pay a dividend either, I'm just not very interested in this finance related stock myself. Apart from that though, we saw the same 3 spec stocks make the list once again that are frequently included in our weekly updates as either a gainer or a loser, but usually a loser. But this time DraftKings, Cloudflare, and Twilio all rose by about 30% each. And like I've said before, Twilio is probably my favorite out of this specific bunch here, but I don't personally own any of them myself. DraftKings though, I'm actually surprised that it climbed because it looks like the online gambling proposition for California is getting rejected, which is a huge potential market for them. So I would have actually thought that this online betting company would have perhaps sunk this week, but it actually climbed. A couple other popular spec stocks that climbed though were DocuSign and Snapchat, both climbing by over 27% each. Now personally, I've never liked Snapchat stock and I just can't really see them being successfully competitive with the giants of, Facebook, Instagram, and TikTok at this point. But DocuSign, well, that has actually always been on my radar because I think that's a very high demand business. They're of course the company behind those electronic signatures that you've probably used many times to sign a contract or various things. And they also offer a lot of other services too, like file management, organization, and all kinds of HR related stuff too to different businesses. They've also been working hard towards profitability in recent years, but I don't think there was any particular reason why they climbed this week because they didn't actually report earnings, but maybe the fact that it was just so heavily beaten down at this point that I think the market rally just probably lifted them up because at the end of the week, they ended up climbing by 15% on Thursday and then same thing on Friday as well. So it looks like that was probably the reason. But from its highs, DocuSign is still down a massive 83%, and that's mostly because its growth is plummeting after the pandemic, with EPS only expected to grow by 20% on average versus the 143% growth that they saw in the previous 5 years. Valuation-wise, it was also way too expensive in the past, but now after the crash, it's at a PEG ratio of around 1.3 and a price to sales of about 4, which I think is not too bad, but Revenue is only expected to climb by 10% next year, so I don't know. I think it may still be a little rich here, but I can understand why investors are picking it up this week as maybe a long-term spec play. I already own way too many spec stocks myself though, so I'll be sitting out on this one for now. All right, with that said, let's finish up here with the biggest losers for the week. And really, there wasn't anything too exciting this week. I mean, we had a Merco, which is the company behind the U-Haul storage service. They saw the biggest drop of all at over a 90% plummet, but that was actually because of a planned spin-off of one of their subsidiaries, and the charts just haven't properly adjusted to it yet. I think from the top, it's actually down like a much smaller, like 30% from its highs, like overall. But I honestly don't know enough about this company to give an opinion on it, so I don't really know what to tell you. I've never been that interested in owning like a storage company or things like that. But anyway, apart from that one, there was a ton of Brazilian stocks crashing this week, and I personally don't know anything about Brazilian stocks either, especially these financial banks, since I have never even been to Brazil myself, but it looks like they took a tumble this week, maybe because of the recent presidential election, and they've been having some issues with that. So that's kind of my guess, but I'm not really too sure why these were falling. But really, the only stock on the list that really stood out to me was Robinhood, since I not only own that stock myself, but it's also one of the most popular stocks among millennials. And this week they fell by over 16%. But it wasn't really due to any fault of their own. In fact, they actually had recently released pretty good earnings that beat on both the bottom line, while also seeing a small recovery in stock trading, options trading, and even a giant increase in interest revenue of 73%. Might be related interest rates, I'm not entirely sure, but they were seeing a nice recovery. However, cryptocurrencies continues to weigh on Robinhood in a major way because the crypto market has really been crashing. It's at like a multi-year low, and that caused their crypto trading to fall by 12% this latest quarter. And then this past week in particular, the stock fell because one of their largest investors in the FTX crypto exchange, they are basically going bankrupt from what I understand, and so they're getting bought out. They're kind of getting like saved, I guess you could say, but they're getting bought out by another exchange called Binance. And so the fear now is that the FTX founder, Sam Bankman, is going to have to sell his 7% stake in Robinhood because his wealth is just crumbling. So, he might sell Robinhood stock. He has 7% of it. He might sell that in order to make up some money from everything he's losing from FTX, basically crumbling. As a result, Robinhood investors started to sell the stock probably preemptively just in case he does end up selling, and that caused the stock to crash by almost 20% on Tuesday and another 14% on Wednesday before the broader market rally helped it recover by 10% on Thursday and another 13% on Friday, leaving it down only around 15% for the week, but it is still down over 40% just this year alone. My personal thoughts on that is I think it's more of a short-term issue. I don't see this really having a big impact on Robinhood stock over the long term, but I'm not personally the biggest fan of Robinhood stock as much as I used to be. I actually sold some Robinhood stock a while back, which I've covered in videos, and now I only own a very tiny amount of Robinhood. It's well below 1% of my portfolio, and I'm just kind of holding that long term because I do feel that they have potential to be a market leader in the stock broker market, especially among young investors that can grow older on the platform and they can keep bringing in more and more younger ones. But overall, I think it's a very volatile, speculative stock, and I don't see that changing anytime soon. So I would exercise extreme caution if you're even thinking about investing in Robinhood. But anyway, that's going to do it for this week's update. Let me know what you guys have to say down below. Feel free to go off on anything you want. Talk about politics if you want. Talk about stocks. Let me know what you're investing in. Let me know what you're staying away from. I'd love to hear your thoughts. I'll respond to your comments, and I'll catch you guys in the next video. Thank you again for stopping by. Hope you're all doing well. Take care. Bye-bye.